All right, we'll get started. Again, thank you for joining us. My name is Jeff Foley with Paladin Financial. Thank you for joining us for our quarterly Lunch and Learn webinar. And this week, or this quarter rather, we've got a great topic we're going to talk about that we get a lot of questions from folks regarding not only cryptocurrency, but other digital technologies that are out there and are really growing very quickly. So we wanted to take some time and talk about some of the investment opportunities that come about from that. And the purpose of the webinar today is not to encourage you necessarily to invest in these things. It depends on your situation. But I think first and foremost, being aware of what's out there and where things are going over time. So we have some opportunities that we'll talk about. And part of the process that we go through each quarter is we try to add value to our clients in a variety of different ways. And one of those is through this webinar series. If you're not familiar with our firms, I see there are a number of guests on here with us. We're an independent advisory firm, and we help our clients in a variety of different ways. If I was to sum up what you see on the screen here, I would say that we're helping people to have an organized plan in what they do as they prepare for and navigate everything for retirement. So we do financial planning, investment management, help our clients to minimize taxes, and all of this plays into what we're going to talk about here today. So why are we talking about crypto and some of the technologies out there? It's really a broader topic than that. Again, our quarterly educational webinar series, we want to continue to add value. But as I mentioned in the beginning there, we get a lot of questions from people very specifically about cryptocurrency that we'll talk about, but other areas as well. And there's always a fear of missing out. So I'll often hear from people that say, well, my neighbor made 40–50% invested in Bitcoin or something like that. Should I be doing this as well? And then I'll meet with people that lost 50%. So there's always a fear that that's the next best thing or the next greatest thing out there. So we want to talk about what your opportunities are and some of the risks that come along with that. The future is here. So if you look back 10 years or even 5 years ago, many people, probably myself included, wouldn't have imagined that you would be exchanging money with people by the use of your phone. So whether that's moving money from one bank to another or paying someone through what is now Venmo, that would be a very foreign concept 10 years ago. And even things like Amazon. I remember, I'm embarrassed to say this, when Amazon first started becoming a thing, and I was talking to my wife and I said, if I just want a pair of socks, I'm going to go down to Target or Walmart or wherever, buy the socks, and I'm done. It's so much easier. Why would I mess around on the internet? Fast forward to today, it's midnight and I'm ordering Tupperware or whatever it might be. I don't order Tupperware, but that's out of my range. But yeah, things have changed very quickly. And if you look at some of the things that we'll discuss here today, I'm pretty confident 5 years, 10 years from now, and we look back at this things we're going to discuss here today, they're not going anywhere, but they're definitely going to evolve. So there's some risks in investing in specific companies, but there are opportunities to look for places that are going to be the next Amazon in some of the spaces that we talk about. So definitely are some investment opportunities there, but also risks that go along with that we'll discuss. Now I have here with me to my right here, Tyler Ellegard is a portfolio manager with Gradient Investments, which is a strategic partner of ours, and he's literally probably 40 yards down the hall from us. So Gradient Investments is the portfolio manager that we utilize to manage our clients' assets. Tyler is what's called a CFA, Chartered Financial Analyst. And before we get into the stuff that's on the screen, Tyler, tell us a little bit about first, what is a CFA and what exactly do you do within Gradient Investments?
Yeah, so CFA is kind of the gold standard, if you will, for portfolio management services. So you cover a broad range of different topics. You need to know in depth of those topics, and you go through 3 different levels of exams, essentially. So it was a grind to get through it. Through COVID, it was about 4 years to actually achieve the designation. So it takes a little bit of grit to finish it up. But
the CFA exam, correct me if I'm wrong, you walk into that and you not only bring one financial calculator, you bring 2 in case there's a blowout.
And batteries. And batteries just in case. Yeah, it's although it's changed a little bit. You know, my first 2 exams, it was in a big auditorium with about 1,000 different people, and then after COVID, for my last test, it was computer-based. So it was a little less intimidating going to the computer-based than it was walking to this massive room full of people.
Good. And so what do you do within Gradient Investments?
Yeah, so I'm a portfolio manager for Gradient Investments. I started out as an investment analyst. and then kind of work my way up a little bit. But I manage all of our fixed income portfolios, and then I manage our international energy and then our digital discoveries portfolio, as well as precious metals. So, variety of different topics that I cover, but most of my focus is on the fixed income side.
Okay, so this year fixed income, bit of a rough year for things with interest rates having increased. But
yeah, I mean, I think the bond market's down about 13% this year, which is very out of the ordinary.
Yeah, good.
Unfortunately.
Very good. So, and you have counterparts that are managing other aspects, different specialties.
Exactly, yeah. So Keith Gangle does a lot of our growth and core stock portfolios. Jeremy Bryan does our value G50 and then the endowments as well.
Okay, good. And the market, there's a lot going on. You mentioned the bond market's down quite a bit, which is a little bit unusual. On the screen here, what's kind of going on in the market now? There's been some news this week that has further impacted things.
Yeah, for sure. So like I said, bonds are down about 13% this year. We had the Federal Reserve come out yesterday, announced another 50 basis points or 0.5% increase to our federal funds rate. And the Federal Reserve's job is really to try to tame inflation and also maximum employment, right? And so obviously inflation running at 7.1%, which is a reading that we got out on Tuesday of this week. So a few different data points coming out. Obviously 7.1% is not a great number. So what the Federal Reserve is trying to do is use that federal funds rate that they raised this week, 50 basis points, to try to tame the inflation. So they're trying to cool down the economy by raising interest rates, making it more expensive for you to borrow money.
Okay, so inflation was 7.1%, but that was actually good news, which is a crazy thing to say.
Kind of weird to say that, but yeah, 7.1% was better than expected. We were expecting a 7.3% inflation rate. So all in all, it was good news for the most part. Some bad news today, though. Retail sales came in where she declined 0.6%. So people are not spending as much as they were from the same point last year. So, obviously inflation is taking a bite into that.
So everyone listening needs to go out and shop after we're done with this and drive that back up.
Yeah,
good.
Exactly.
Good.
And stock market obviously has not been great this year as well. In the stock market, the S&P 500 is down about 19% this year through today. So it's been a challenging environment. There hasn't really been anywhere to hide, right? I mean, a conservative investor is down about the same amount as a growth investor this year. So it's been challenging. The only real place that you could hide out was gold, which not a lot of people saw coming. So, gold's down about 3% this year. So it's been a difficult environment. And our outlook for next year is relatively positive. I mean, as we go through the first half of 2023, we do think volatility will continue. We may see a recession. How deep, we're not 100% certain yet.
Mm-hmm.
But with how aggressive the Federal Reserve is being with their interest rate increases, there's a likely chance that we'll see some type of recession in the first half of next year.
Okay.
But as we transition to the back half of 2023, we think we're set up pretty well. So, we may retest the lows in the market that we saw back in August and October, but I don't think we'll go much lower than that.
Okay.
So back half of next year looks a little bit more appealing. But again, our best advice is to stick to the plan that you have, right? You work with all of your clients on those plans. And our advice is always just to stick to that, because we will have ups and downs throughout the course of each year, 5 years, 3 years, whatever the time frame might be.
Yeah.
Every year is going to have some type of drawdown in the market. So it's always important to stick to your plan. You can reassess that plan, but try to stick to that plan that you put in place.
That's a good point. One of the studies that I like to reference is if you look over a 15-year period in the S&P 500, the average return during that time frame was about 9%. If you stepped out of the market and you missed the 10 best days during those 15 years, 250 trading days a year, that's a lot of opportunities. Just 10 days, that return drops to about 4%.
Yep.
Which is amazing. So it can move very quickly one way or the other. If you don't need the money, let it stay invested. And do its thing over time.
It's interesting when you think about that, because some of the best days come after the worst days, and most people just emotionally want to get out of the market. They want to go to cash the day after those bad days, but then a day, 2, 3, whatever it might be, within 10 days, you tend to have some of those best days in the market. So people tend to miss those because of that emotional nature to get out.
Good. Yeah, it's like life. We often have our best days after our worst days. So yeah, that's good. So both sides of the risk coin this year, a little difficult, but we'll be.
Yeah, I mean, on the bond side, you know, we actually get income, which is a nice change of pace. So bonds are a little bit more attractive, and then like I said, stock market, we're set up a little bit better for the back half of next year, but we're pretty positive for next year.
Okay, good. So pivoting into the topic we'll spend most of the time on today, digital discoveries, and I mentioned crypto there a little bit ago, Bitcoin, some of those things. So Tyler is going to walk through some of the technologies that are out there. And again, I think some of the stuff is both fascinating, and I'll go back to my pre-Amazon self of why would someone do this? And I'll jump in, comment on a couple of these along the way, but there are some interesting things that are evolving over time. So I'll kind of let you take over.
Well, to that point, I mean, I don't know exactly what year Amazon became public, but I mean, it's grown to almost $1 trillion company or slightly over, right? Nobody would ever thought that back in 1990s. So it's always important. Yes, there can be some fits and starts, and Amazon at one point had, you know, massive losses in the stock market, similar to the digital assets that we're looking at today. It's always important to look to the future. What are these technologies? What is the purpose of these technologies? And how can they be incorporated into our daily lives? And is there a use case for them? And so most people attribute digital assets or the evolution of technology to just crypto, right? So Bitcoin, Ethereum, those are two main coins that people pay attention to. Those are both down pretty dramatically this year after some significant performance in the last couple of years. Coinbase is a platform that people use to trade those cryptocurrencies on. That's down big this year. And then you can see that some of these other ones, kind of the main industries within the digital assets or the evolutionary aspect of digital assets are down big as well, right? There's a few reasons to that. You know, they've had some outsized performance in the last couple of years, whether that's through some pull forward of expectations for growth or uses through COVID, right? Because a lot of people were locked down, they were spending time at the internet, they were trading digital coins. People were paying more attention to the evolution of our technology, and so they had some outsized performance. So I think part of it is the excess steam coming out of the system right now. But there's also been some issues that we've seen in the news lately. So we can go to the next slide here. You know, starting in June, July timeframe, we really started to see some cracks in the system, especially on the crypto side. You had some different platforms, Three Arrows Capital, a hedge fund, Celsius, BlockFi, Voyager Digital. All of them ended up in a bankrupt situation because of some excess lending and excess leverage. And so a lot of people started to feel that after this happened, we were kind of getting into the space where, okay, maybe now cryptocurrencies and this digital asset space, that excess is gone, and maybe now there's some store of value to be had, right? You saw the volatility of the coins kind of go lower. You know, they weren't going up 10% each day, or they weren't going down 10% each day, and so they're kind of trading in a more normalized range that we would expect with a currency. And fast forward a little bit, this stuff kind of got sorted out, but then starting at the beginning of November, we saw FTX, which was the second largest trading platform. They went bankrupt in 3 days. A $32 billion company going bankrupt in about 3 days.
That's an issue.
That's a little bit of an issue. And you know, regulators are still kind of sorting through the issues of what happened. We now have a better understanding of what was going on with FTX. It was fraud, money laundering, all of that is what Sam Bankman-Fried, or SBF, has been charged with and officially arrested as of this week. But now there's some concern on the first largest trading platform, Binance, right? So number 2 is bankrupt. Number 1, people are concerned about some issues because they're withholding non-withdrawals for certain coins. So there's still some uncertain issues that are in the system right now, which is why some of those coins and assets are down so big this year.
Yeah, and I think part of this too is separating the companies or the things from the technology itself.
Yes.
So if we go back to my example of Amazon, or even further back, the internet, when the internet started becoming a thing, all these companies sprouted up and got involved in that, and so many of them more are not around today than are alive today, but that technology is huge.
Exactly.
It did not go anywhere, but you don't know which companies in particular are going to be the Amazons of the future, the Microsoft of the future. But so I think that's the difficulty with this, is people need to a degree separate the investment from the technology, and that's part of what you'll talk about is how do you go about doing that. There's certainly risk there, but you want to be aware of that.
Yeah, exactly. And so as we go into this next slide, as we start to talk about Bitcoin prices, right, the Bitcoin itself wasn't the cause of FTX or Binance or any of these companies going bankrupt. The technology behind Bitcoin is still there, but people start to associate FTX issues with issues as a whole industry with digital assets. And so people don't want to be involved in those potential risks because, again, you can see it in Bitcoin prices, they've come down. But one thing that we started to see back in COVID was people were talking about Bitcoin as an inflation hedge. And I just wanted to bring this up real quick, or just touch on it, because that notion of whether it's gold being an inflation hedge or Bitcoin being an inflation hedge or Bitcoin taking over gold, that scenario has kind of gone upside down, because as we've seen Bitcoin prices come down, obviously inflation has been driving higher, and now all of a sudden inflation is starting to come down and Bitcoin prices are coming down. So that correlation between higher inflation, higher Bitcoin prices is much higher than what you were expecting going into this higher inflationary environment.
Yeah.
So just want to throw that one out there. Yeah.
Good. So, and apologies, I think the slides were stuck there for a moment, but you should be seeing that again. But yeah, there's a lot of fear and uncertainty, well, FTX and some of the issues that are out there right now. But again, separating the things from the overriding concept, the technology that is out there. So Gradient has a portfolio that invests in some of these different things that you're going to talk a little bit about. Can you explain what that is?
Yeah, I mean, timing could have been a little bit better for the portfolio. We officially launched on October 1st, and then November FTX happened. So FTX wasn't a public company, so we weren't invested in it. But
and make sure, if you would, explain that too, is the difference between public and private, and why does that relate to FTX versus what you're investing in?
So our focus within the digital discovery portfolio is on using ETFs, or electronically traded funds, to invest in public companies. And so the reason for investing in public companies versus investing in private companies like FTX, you have a lot more clarity into what the business is doing. You also have liquidity in public companies. So we have clarity through the companies that we're investing in, which is a key ability to look at and assess risk. And then also, we're not locking anybody's money up using ETFs and publicly traded companies. So if you want your money, you can get it whenever you want. Whereas if you're investing privately, you may have a 3, 4, 5 year lockup period for that. So we're always focusing on public companies that have liquidity and have regulatory authorities auditing balance sheets and making sure that they're doing what they're supposed to be doing, and not getting into the FTX issue of commingling assets and not telling anybody, or borrowing funds and not telling anybody, right? So that we want to focus on that, where there's regulatory authority governing those companies versus companies that aren't and unregulated. So the objective of our digital discovery portfolio, again, is to really focus on innovation. And ideally for capital growth going forward, but the innovation is the important part. and the technology behind that innovation. And so we're going to have that exposure to stocks through ETFs to target that technological revolution, right? We've evolved at a very rapid pace, and we'll continue to do so. And so we want to be involved with that.
Mm-hmm.
And then that last part, the execution, again, we're going to be actively managing this. So if we feel that, crypto as a whole industry is very attractive right now, we may add that as a higher allocation in the portfolio versus, say, NFTs. And we'll get into what those differences are. But we'll actively manage those weights to make sure that what we're exposing clients to is what we feel is the most opportunistic.
Okay. Perfect.
And again, we're looking for growth here. We're not looking for dividend income. But again, there's going to be risks and potential for opportunistic growth within this portfolio.
Yeah. Good.
So again, we're focusing on the four key themes within this technological revolution. First one being blockchain. Second one is cryptocurrencies, which a lot of people know or have heard about. And then the other two, metaverse, you think of the VR goggles.
Mm-hmm.
And then the last one there is non-fungible tokens. This is probably the one that most people haven't heard of before. So blockchain is really the backbone to all three of these other areas or industries. Blockchain is a decentralized but digital ledger that is distributed widely so that not only one person has that ledger.
Yep.
So if you and I are transacting together on let's say on Jeff Foley's blockchain, everybody in this office can see exactly what we're transacting on and how much it was for. And then what it's doing is it's saying it's essentially unalterable because you have a copy of the ledger, I have a copy of the ledger, and everybody in this office has a copy of the ledger. And so if you try to go back in and say, no, I actually sold this product for, let's say, $60 instead of $50, all of us are going to get a notification, and we're going to have to verify that and say, no, that's wrong, and we'll change that verification or that transaction back to the $50 that we originally agreed on.
Okay. So blockchain is not a company, it's a thing that everyone has access to if they need it or wanted to.
Yep, exactly.
Okay.
And so again, it's the backbone for the cryptocurrencies, metaverse, and non-fungible tokens. It's what everything is going to run on because we need to have that verification that gets sent out to everybody.
Mm-hmm.
Cryptocurrencies, again, the basic concept is a currency, right? What a lot of people start to get confused on is the mining of cryptocurrencies. Like, what does that really mean, right? Well, the blockchain, if you and I are going to send Bitcoin to each other, I'm going to send you $50 worth of Bitcoin, what's going to happen is that's going to get recorded on the blockchain, okay? But in order to make sure that transaction is verified and continues to be verified, there needs to be other computers or other people on that blockchain to verify it, essentially,
Okay.
right? Following with me so far?
Yes, yes.
So if you're going to be on the blockchain verifying all of the information, right? There's going to be thousands of different transactions happening on that blockchain. You're not going to do that for free, right?
Mm-hmm.
So what you're going to do is you're going to be on there verifying all of this information. You're going to be cracking the codes or completing the algorithms for the blockchain, all of that happens behind the scenes. And if you do that enough times and do it quick enough, you're going to be rewarded with a cryptocurrency like Bitcoin. Okay, so that's what mining is. You're essentially being rewarded for verifying transactions on that blockchain.
Okay.
Because you don't want to do that for free.
And you can't pick your neighbor or your best buddy to be the verifier of the.
Correct.
Of
Yep. So there's thousands and hundreds of thousands of computers doing algorithms and completing algorithms millions of times every second. So they call that a hash rate. We won't get into that today. But the higher the hash rate, the more computing power that blockchain has, and the more competitive it is to try to mine. So blockchain or Bitcoin is obviously the most well-known and has the highest hash rate, so it's the most secure effectively. And in order to hack the system would take an immense amount of computing power. So that's why people consider it a safe alternative to whatever it might be.
Okay.
So cryptocurrencies, again, you use that as an exchange mechanism, right? There's thousands of different coins. I wouldn't recommend going down that rabbit hole. I would stick to if anybody ever wants to look at cryptocurrencies, stick to the main few, but I also tend to stay away from just an individual coin, which is why we offer the digital discovery.
Okay.
Metaverse is it's if you, going back to your Amazon example, if you said that you were going to have all or a large portion of your meetings, whether it's internally or with your clients, over Zoom, right? If I had told you were going to do that 3 years ago, you wouldn't have believed me, right? COVID has changed that quite dramatically. Metaverse is kind of that next evolution, right? So we all have our VR goggles on. We're sitting at home, but it feels like we're sitting in this office, right? That's a basic example of what the metaverse will be. Another one that I like to use is grocery shopping, right? So like I order my groceries online and have them delivered, but I always do a much better job of grocery shopping when I actually go to the store, right? What these goggles or what this metaverse is going to allow you to do is actually walk through a grocery store, pick items off of shelves, put them into your cart, and then 30 minutes later they get delivered to your door, right? All from the comfort of your own.
No free samples though. No.
Yeah, exactly. Unfortunately, that'd be a pretty cool thing to have. But that's kind of the next evolution of this Zoom is having these virtual meetings, but it feels like you're actually in a conference room rather than on a computer screen.
So there will be so many applications, and I'm sure already are, to that type of technology. Business travel, that changed with Zoom, and now it's kind of reverting back where people are back on planes and cars again. But as this evolved, there will be companies that only do metaverse meetings, and they cut down their travel budget. So there are a lot of things there.
Yeah.
One of the crazy examples I heard of this is someone, I don't know where they are in the world, but someone spent $400,000 of real money to buy in the metaverse property next to Snoop Dogg. So they wanted to be able to say that they were Snoop Dogg's neighbor in the metaverse. So they paid $400,000 to have that piece of real estate that doesn't exist. So it's just, some of this is mind-boggling, but the applications are going to be huge. I don't think there's any debate on that. But again, the companies that are investing and building and growing in that, the majority of them might not be around in 5 or 10 years, but the technology will keep moving forward.
Exactly, yeah. And like I said, I mean, there's a lot of funny money that has gone into this space, which is why performance or the fear of missing out has been so large over the last couple of years. All of that is now starting to come out of this system, right? That $400,000 property, I can guarantee you, isn't worth $400,000 anymore, right? That person probably could sell it for a fraction of that price now. So a lot of that air and steam is coming out of the system, which I think is a good thing overall. But yeah, it's important to focus on the technology, which is what this portfolio is trying to do. Last one here, this is actually one of my favorite sections. It's, again, this is where a lot of funny money has gone into over the last couple of years, investing in digital art, the Bored Apes. I don't know if anybody else has heard of those, but non-fungible tokens have a very large and wide-ranging use case. And so, yes, digital artwork is one of them. The digital Mona Lisa, whatever it might be, the first tweet from Jack Dorsey, you own the rights to that, right? That's number one. But collectibles and domain names and all of these different things, your social security card is one of my favorite examples. Instead of having that stuffed away in a savings deposit box somewhere or in a safe in your house, or maybe you don't even know where it is, you will have a digital wallet that's secured, and you'll be able to have your social security card within that digital wallet. And the only person that has access or the right to that social security card is you and your wallet, right? So making a lot of these things, or the title to your house, or your ID. Like I carry my wallet around only because of my ID. My credit cards, everything else, is all on my phone. I can pay anywhere I want with my phone. I have everything else that I need on my phone. The only reason I have my wallet is for my state ID, driver's license, right? So eventually that could be part of your digital wallet. It could be an item or a non-fungible token within your wallet. So I think this space has the most wide-ranging potential. Again, a lot of funding money has gone into it, mainly on the digital artwork side. But I think as the technology continues to build and grow and the uses begin to expand, I think this is going to be one of the more widely accepted areas or industries within digital assets.
So many, yeah, and if you drill down in each of those areas, there are all sorts of niches within each of those technologies that have to evolve to make those things happen. And there'll be companies that sprout up in each of those areas. So.
Yep, exactly.
Excellent.
So within the portfolio, again, I said this earlier, but we'll always use ETFs. We want to make sure that clients are liquid. And within ETFs, they're going to be invested in anywhere between 20 to 100 different companies.
And what is an ETF, if you would?
So it's essentially a group of companies that you'll own a slice of, right? So instead of buying within your portfolio 5% of this company, 6% of this company, 7% of this company, whatever it might be, you're going to own 100% or 50% of this ETF, which will have a slice of this company. The ETF might own 5% of this company, 6% of this company, 7% of this company. So you're going to own a basket of companies within one essentially wrapped up ticker or ETF. Okay.
So same business model as a mutual fund, but kind of packaged with modern day technology. You put in $100 or $100,000 or $1 million, whatever, into an ETF, and you own that one ETF, but it's diversified into whatever it's invested in.
Yep. Okay. So we'll own anywhere between 5 to 10 different ETFs within the portfolio. Again, we'll allocate those based on what we feel is opportunistic. So we might own 30% across 3 different ETFs in the crypto universe that have different exposures. We might own 1 ETF in the NFT space or non-fungible token space because we feel that's less opportunistic, right? So we'll kind of base our weights and our allocations on where we see fit. And then again, ETFs are liquid, right? So you had mentioned mutual funds. Those tend to trade at the end of the day. They might not be as liquid. They still are relatively liquid, but ETFs trade daily, just like a stock would. And so we want to make sure that, going back to the public versus private, we don't want to lock anybody's money up. So we want to make sure that clients have full access to their money. They can get it out within, I think it's T-2 days or whatever. The ETFs are, so you take it out today, you can probably get your money into your bank account on Monday, right? So we want to make sure you have that liquidity. And then the last one here is very important. We wanted to emphasize this. We're not going to directly own any cryptocurrencies or NFTs. So what we want to focus on is the technology behind cryptocurrencies, or maybe just a generalized direction that cryptocurrencies are going. So we're not going to go out and buy Bitcoin. We're not going to go out and buy Ethereum. The way we're going to gain exposure to cryptocurrencies is through the companies that are investing in that space. So whether it's owning a portion of Coinbase, right? Coinbase is the platform that cryptocurrencies trade on. We might own a mining company, right? We might own Silvergate, which is kind of like a crypto bank, right? So we're going to have exposures to cryptocurrencies, but through the companies that are involved with the space or the technology behind it. We're not going to own it directly.
Got it.
Because we believe in the technology, not necessarily a specific coin.
So the NFTs example, you're not going to have ownership of a Bored Ape, NFT. If you're not familiar with Bored Ape, you have to Google that, and it's crazy the amount of money people spend on some of those things. But you're not owning those things. You're starting at the ETFs and diversifying into technologies and companies.
Yeah.
Good.
And so this is the current allocation that we have. So metaverse, blockchain, crypto, NFTs. Those are the four main industries that we're going to be focused on. There is going to be some overlap. There's also going to be companies within these. My favorite one to look at here is that First Trust, LEGR, the transaction and process. So when people think of Bitcoin or blockchain, people tend to think of small, new companies, right? Well, within the ledger, one of the top holdings is MasterCard and Visa and PayPal, right? Very well-known companies, very established companies, but they're investing in this space. So when you think about a crypto or blockchain or metaverse, it doesn't have to be a brand new company. We can invest in mature companies. So what that does is it reduces our risk profiles a little bit. Again, there's still going to be a lot of risk within this portfolio, but it can reduce our risk a little bit by investing in some of these more mature companies. And so metaverse is a good example. Facebook, right, or their new name, Metaverse, right? They're a very well-established company, and they're a top holding within the portfolio, right? So just because this is a new space doesn't necessarily mean that we can't own some of these big, well-known companies.
So use the example of Visa and MasterCard that are part of what you would own in having that ETF. So correct. Visa and MasterCard are looking at this just like everybody else and saying, this isn't going anywhere, but we need to be involved in that and make sure that they don't, they're going to get pushed aside as that technology evolves.
Or Amazon. I mean, Amazon Web Services has their own blockchain that you can build on and create whatever you need to on that blockchain. Amazon has that service, right? So Amazon is a holding within some of these ETFs that allows us to again, own Amazon because they're investing in that space. So
good. Okay. So some things to think about with that, with next steps, and what do I do with that information? Again, the goal with this is not that people are putting a lot of assets into this. I would say 3 to 5% if someone was going to utilize that type of portfolio. It's a diversifier. It's not a all my chips are into that. Your better bet would be things like S&P 500 and different ETFs that have diversification in a lot of different areas. But this has its place over time and will continue to grow and evolve. And as the air gets let out, as you mentioned, kind of the funny business within some of those companies gets hammered out over time, it will move even faster forward. But it's a very interesting thing. So I would suggest for folks, be open, be aware of what's going on out there, that there are opportunities, and kind of explore that a little bit. Be mindful. I've met with folks over time that have invested in different things, different companies, and then that thing is no longer there, whether it's Bitcoin is down 50% and they had all their money in it. We don't want to see that happen. So be aware, but we don't want to necessarily close the door to opportunities. Call us if you have any questions about what we went through today or the portfolio or anything else as it relates to investments and financial planning. I know we have a mixture of our client friends on here and people that we're not currently working with. So call us if you have any questions about anything. For those that are not working with us currently, I won't go through all of this, but these are examples of some of the things that we help people evaluate and make good decisions with respect to their retirement plan. So if you're saving for or you're in retirement and you want to get the most out of all of your stuff, your investments, Social Security, etc., that's what we do, is help people to pull all those puzzle pieces together and put them in the best frame possible, help you to maximize everything that you see there. So we offer a complimentary second opinion on your retirement plan. All you have to do is give us a call, schedule that. That's usually a 2-meeting process, and we can go through more details over the phone with you on that. But hope that was helpful. Also encourage you, if you're not following us, our podcast, Paladin Financial Talk, please check that out on wherever you listen to podcasts. Actually recording our podcast here today, we're going to talk about year-end tax planning opportunities and some things to be aware of that are changing on the income tax front. And that podcast will be available on Saturday. So tune in, as I like to say to that. And we'll wrap things up again. Tyler, thank you very much for joining
Thanks
us
for
and
having me.
educating us on something that's very interesting. I'm not going to make the same mistake I did with Amazon a long time ago, but it's very interesting to see where
Yeah.
that's evolving to over time. So we do appreciate your time.
Of course, thank you.
And anyone call us if you have any questions. And thank you very much for joining us. We'll talk to you later. Bye-bye.